Mike Muller, head of Vitol in Asia. What stands out from you in the month that has passed that we'll still be talking about in a month's time, that maybe will have more legs rather than be moments of a kind of spike moment? Your thoughts on the month in review?
This is normally the busiest month of the year for most people in our space, just in terms of getting ready for next year. And it's the time of year where you look forward to the next year in terms of term commitments, relationship building, strategy sessions, etc. So, yes, it's been amped up by a lot of news. Maybe I'll leave the geopolitical developments to one side for now because everyone's been following them since they're so high profile. I was surprised by the reaction of the markets to the China stimulus package, which was initially dismissed as, well, okay, they're trying, but they're trying to accomplish something which is very, very hard to move. Right on the cusp of Chinese Golden Week, so China's been on leave for the best part of since the middle of last week, and they will continue to be on leave until the middle of this week. And therefore, with markets closed in China, you've got a lot of talk of where the informal markets, the OTC markets are. But just before the holiday, equities markets and certain key commodities, not oil, by the way, but certain key commodities linked to the construction sector, which is the one the Chinese government really wants to give a stimulus to, did move. And China kind of caught a bull wave, if you like. And everyone I know in China is either anxious to buy more or wishes they bought more or is actively getting long the stock market. So it really looks like the government has decided to set about it with some purpose. In terms of oil markets, I mean, yes, we cycled up to close to, well, we got above $78 and we're sitting around about there now. That is a price that few would have picked, but people are debating what sort of premium to place on the risk of disruption to critical oil and gas supply infrastructure. In the case of Gaza, we've been talking about it for many, many months. There's a lot of gas infrastructure very nearby. There's a dependency on Israeli gas from Egypt, for example, which not many people talk about in oil circles. And on the oil side of things, I mean, I guess even fewer people currently wish to send ships through the Bab el Mandeb as the Houthis continue rattling that supply chain. So the market has gotten a lot more bullish. At the same time, we're at the tail end of summer consumption season. So key indicators people watch, like inventories of gasoline in the US, are very, very low. There's been a big draw of inventories on the water of refined products. Of course, we've also been and finished trading the key refinery turnaround season. And that's been exacerbated a little bit by Libyan oil going missing, mostly in the month of September. And also exacerbated by the traditional stock draws I talked about. So suddenly, a lot of the oil markets, be they diesel, kerosene, even gasoline, and of course crude, feel a lot tighter than they did a few weeks back. And everyone has had a slight change in mindset saying, well, given that, and I'll finish with this, given that a lot of the speculators in the markets, the managed money in places like New York has been off the oil market completely. In fact, some have even been short. That risk-off mindset may no longer be appropriate given the geopolitical events we've been watching. And there's been some evidence that some of that money has been coming back into the space. And that's got the potential, of course, to cause a market which is more volatile.
Mike, if we sort of take one of the threads through the last month and that continues to be relevant, and that is the OPEC decision that started the month on the eve of APEC, which you and all of your colleagues there hosting APEC, the biggest gathering of energy market stakeholders each year in Singapore. The OPEC announced that it was postponing its increases from October 1st to December 1st. Then, sort of some halfway, 2 weeks or so later, we had the Financial Times article announcing that the Saudi sources were telling the Financial Times that they were ready for a market share battle, war, however language they were indicating. And then even in the last few days, the OPEC noise is churning out stories. Wall Street Journal reporting that the Saudi minister had mentioned or threatened a $50 price if compliance actors didn't get involved. Now, putting aside all of the geopolitical traumas that are currently in the mix, but just taking the OPEC strategy through line, how do you see that? What we've all heard together, and truth or untruths to it all over the last month. How important is continued managed supply by OPEC to the through line going forward to the next month?
Yes, Sean, if you cast aside all the geopolitical noise, it is extremely important that OPEC Plus continue to show a consistent strategy and do what they say they're going to do, because the market, it does hang a lot of forward hope on that. The price that we see today, of course, $78 Brent is a price that nobody's particularly unhappy with. OPEC should be quite happy with, but there is a possible scenario where if the fighting were to stop and the world were to calm down, then some of the fundamentals Christoph was outlining would restore the inventory draws and bring back a balance. And most analysts see modest stock builds early next year. That would bring the market into a regime where people are very certain of the spare capacity being a reassurance, a cushion under the market, and we may well cycle lower. So I think APEC indeed was a bear frenzy that ended up slightly overdone. Indeed, halfway through APEC week, the market went bid again and shied away from those very low 70s and high 60s prices that we'd seen. But there was a reason for it. Everyone got worked up after comparing notes on China in particular. And that's the economy that's responded with a stimulus package that has caught a bid, not just in Chinese circles, but I'm sure there are plenty of investors sitting here in Singapore that are trying to find ways of getting long China also, and making sure they don't miss out on what seemed to be an oversold market. Nobody's had much joy buying Chinese equities over the years. This has not been a market that's rewarded shareholders, and people feel this might be a bust they wish to catch. But I think there's been a lot of clarification which has been helpful on the part of the protagonists you mentioned, in terms of non-compliance or under-compliance being rectified and being compensated being extremely important. And some key nations were brought into the public view on that. And then there's been some fundamental announcements also. There would appear to be some production cuts or some maintenance that is quite profound in the Emirates where you're sitting, which will take a significant amount of the key benchmark Murban crude off the market just after refinery turnaround season. And traders took that on board and are now believing that's a scenario which will also bring down OPEC plus output quite substantially. I think anybody who says that the resumption of production and the higher levels of output from OPEC plus from December is bearish. It's a little bit wrong to say that, because that was always the plan, right? That was always a production increase that was meant to mirror fundamentals. Asia, let's not forget, Asia demand for oil peaks in December every year. And as such,
just on that point, sorry, Mike, you mentioned earlier, I just wanted to drill into it a bit, because a lot of discussion in the last few weeks about, if you take the FT article at face value, who exactly was the target of that information? And the general answer to that question was those countries within OPEC plus that are not complying with their cuts. Is that of a scale, do you think, that makes a difference to the trajectory of this market? The Iraq, Kazakhstan compliance versus not, is that of a scale?
Well, it adds up, right? Every little bit matters. So if you're talking about a few 100,000 barrels a day, it can tip balances. Multiplied by 365 days, you get some very, very big numbers if you're talking, say, 200,000 barrels per day or so. So yes, it is important to show that there is no drifting, and that there are multiple countries, not just one country, taking substantial sacrifices in order to stabilize markets as they've set out as a consortium to do. Yeah.
Mike, so your thoughts as well, just taking that China part of that bearish demand growth outlook this year, the stimulus you mentioned in your opening comments, the equity markets in China have certainly reacted incredibly positive to that, but essentially they were on death's doorstep anyway, so a bounce from sort of a very low level. But the impact, the stimulus package, what's inside it, could it indeed succeed in giving China's oil demand a recovery for what appears to be, and now more and more voices saying that China oil demand growth will be near flat this year?
Well, I mentioned before that a lot of Chinese colleagues I know are buying equities, but a lot of them are also looking to take profit and feeling enriched. So they've spent the holiday period changing their holiday changing their holiday plans for winter holidays in the Alps instead of some province of China. So there's extra jet fuel consumption, very, very graphic, and just take as an example. I know two other colleagues have ordered a new car. Now, obviously, cars that China's churning out, subject to a lot of tariff discussion, but even domestically, there's been quite a price war in terms of, battle for market
So what,
share.
the 25, 30% jump in the equity markets has made your average
Yes,
punter feeling richer?
yes, that's right. And spending on consumables, which includes energy consumption. Yeah.
And beyond that, from the point of view industrial or otherwise, I mean, where do you see that trajectory going for China into the sort of Chinese New Year, typically a strong buying period?
As I said, the one sector they really want to fix is construction. And I've even seen people putting down deposits on second homes and getting emboldened by the whole wave there. I mean, it is beggars belief how much this stimulus has exceeded expectations in terms of its impact. Because on day one, my take was this is hardly going to touch energy. It'll influence a few other sectors. But even certain metals markets that you'd associate with construction have taken off.
I wanted to get your thoughts on the moment that we're facing literally today, without getting into the weeds of the geopolitics of it. But we have had announcements last week that from the US president himself and the Israeli government that they are planning some reaction to the Iranian strike on Israel earlier last week, which all put 10% plus on the oil price through the second half of the week. My question to you is from a supply demand point of view. I thought actually 10% didn't seem that much, given what even the US president said, that targeting oil facilities was under consideration. Where is the market's ability at handling perhaps a serious disruption of 1 million to 2 million barrels of oil of supply at a time when, of course, we know OPEC Plus has close to 5 to 6 million barrels a day of idle supply? How big is that balancing factor, risk factor to the market?
Yes, it is a fact that Iranian exports have almost been at their full capacity and therefore have gone unchecked despite a world where sanctions are in force. And this is obviously something that is not lost on people, as if there were to be some compromise of Iranian production or export capability, it takes away from that supply cushion, that spare capacity that Christoph was talking about. But of course, taking away supply security in the shape of a spare capacity cushion is bullish, because it means there's less capacity then to cover for other geopolitical disruptions. And therefore, surely that is something that an administration looking to get re-elected does not wish to see, if in so doing the oil price goes up. So there were a few statements, retractions, and I'm not quite sure which statements were correct or fake news made up by the media at some point, and there seems to be quite a lot of it. So yes, the market went from being quite divided in oil trading circles on whether there would be a retaliatory strike on the part of the Israelis, contrasting it to the April, let's call it tit for tat exchanges, where there were some widely telegraphed retaliatory moves which didn't cause material casualties, and that was it. People let things rest. But this obviously is on a scale that looks somewhat different. So I detected that Thursday, Friday, as we moved into the weekend, there was a shift from 50-50 to more people thinking there would be action on the part of Israel, who, as Christoph said before, seem to be acting as if they have an opportunity here, which hasn't come along all too often, to act unilaterally. And I mean, you've seen protests in the streets. I saw some photographs from a colleague that was posted on one of your chat groups, Sean, of people protesting in Trafalgar Square. I mean, ethnic Jews protesting, yes. So the world is quite confused in terms of where all this is heading. But yes, volatility went up. People are looking to get long call options to give themselves upside protection. And people are talking the possibility of $80, $90, $100 oil again in the event that infrastructure does get hit. And that's why I made that point at the very beginning when you put me on the spot. It's a judgment call on whether there will be any compromise in supply to global markets from the Middle East region.
Mike, last word to you. What will be your kind of North Star through the fourth quarter? We asked at our forum last week the forecast for the average price of Brent crude in the fourth quarter, and that question was asked after the Iranian strike on Israel, and the answer was $70 to $75. What do you think is the number of things that are up in the air, and we mentioned them at the beginning, will give this North Star a direction for the oil markets in the fourth quarter? Is it whether OPEC increases in November or December 1st as planned, or is it the US election? Where do you think will have the biggest bearing on the direction of this market over that 3 month rather than, let's say, this week?
I'm afraid it is the short term. I mean, the market has a pretty range bound mindset. If we were to take away all the geopolitical events in the last few weeks, which had the market adjusting its mindset from a 70-85 market to maybe a 60-80 market or 65-75 type range, we're outside that latter range now, because there's an expectation of disruptions and ongoing hostilities around that Middle Eastern region. But yes, you call it North Star is, I mean, OPEC cohesion is something everyone's going to watch. So that is important and must be maintained because that's your underpinning foundation of the oil price. And then it's going to be demand. I mean, everyone can judge supply. Everyone can make assumptions on the disruptions or even areas like Libya, which have been a little bit fickle. But these constant downward demand revisions have now come to an end. People are probably going to look at revising Chinese numbers back up again because those might also have been overdone on the downside. And then whether that 500, 600,000 barrel a day figure that was floated at your forum is, and that's oil only, by the way, not NGLs and petrochemical use of NGLs, that sort of stuff, that may well go up again. But the undeniable fact is we have more non-OPEC oil coming on than we have demand in the current set of rather bearish outlook numbers. And that poses an ongoing challenge for OPEC Plus to manage.